In 2008, the world experienced the worst financial crisis on record, with people losing confidence in the banking system and the institutions who held their money. And in the end, a $700 billion government bailout was needed to prevent a complete collapse of the financial system. The GFC is described as a once-in-a-century event and likely the worst recession for many decades. So why just 15 years later are we starting to see financial institutions and banks fail again? Is this the start of another financial crisis? Over the weekend, the US experienced its second largest banking failure in history, with Silicon Valley Bank, the 16th largest US bank, collapsing in just 48 hours. And with 95% of its customer deposits uninsured, Bill Ackman and other prominent investors were concerned that there could be significant contagion to other banks and business sectors in the economy. This story is evolving very quickly, including the government bailout that was announced just a few hours ago. So rather than sit here and speculate about what I think may happen, I'm going to share with you the facts of what we know so far and what are the potential outcomes from what we're seeing in the financial sector so far. Silicon Valley Bank, or SVB, was the 16th largest commercial bank in the United States with assets of roughly $200 billion. And as the name suggests, the bank mainly served tech startups, small new companies that are backed by venture capital. SVB's business model was relatively simple. They collected deposits from mainly tech startups and then earned interest on those deposits by buying government bonds, loaning money out, and even participating in venture capital themselves. SVB, like all banks, are only required to hold a certain amount of their deposits in cash. And this works normally because they only need enough cash to fund their normal daily withdrawals, and the rest can be invested to earn interest for the bank. But as you can imagine, a problem can occur when a large number of people try to withdraw all at once. This is what we call a bank run. With some of the protections put in place by the government after the global financial crisis in 2008, bank runs are fairly unusual, but they can still happen. But if a bank simply doesn't have enough cash for withdrawals, but they have the assets in other investments, why can't they simply sell those investments and convert those assets into cash and use that money to fund withdrawals? The bank can and does do this, but if a bank is forced to sell a lot of assets very quickly, much sooner than they expected, it can cause huge losses. In SVB's case, this came in the form of issues with some of their treasury bond investments, which are generally considered safe and a place that banks often store a lot of their assets. A US treasury bond is simply a promise by the government to pay you back with interest over a fixed period. And if the bank buys one of these bonds from the government and holds it to maturity, then the US government will pay them back. But if they need the money before maturity, then they'll need to sell the bond on the bond market, essentially selling it to somebody else. And in that circumstance, they are exposed to whatever price those bonds are going for in the open market. And because of the rapid rise in interest rates over the past 12 months, bond prices have been falling significantly. This was the problem that SVB faced starting last week, with a lot of their tech startup clients having already facing troubles during the tough economic circumstances that we see with inflation and rising interest rates. They essentially needed to sell a lot of their assets in order to fund withdrawals. And ultimately, they had to sell a lot of assets, including US bonds, which they sold at a huge loss. In an attempt to calm nerves and prevent a panic, on March 8th, SVB proposed a capital raise for investors, hoping to gain an additional $2 billion of investment from shareholders. Unfortunately, this did the opposite of what they wanted and ultimately led to many clients trying to withdraw money from the bank. In fact, in a single day, clients tried to withdraw $42 billion, about a quarter of the bank's entire deposits. And since SVB was unable to meet these withdrawals, on Friday the bank was taken over by regulators. A bank run like this happens when customers are scared that they'll lose their deposits, so they race to withdraw before it's too late. To prevent this from happening every single time that people got a little bit spooked, the government introduced some regulations and some insurance to protect customer deposits. The entity is called the FDIC, the Financial Deposit Insurance Corporation, which was founded during the Great Depression about 100 years ago. Today, the FDIC protects protects people by insuring $250,000 of deposits per customer. However, in banks like SVB, which primarily serve tech businesses, most of the deposits are uninsured. In fact, in SVB's case, 95% of deposits are uninsured, which meant that the insurance provided by the FDIC didn't really stop people from panicking when the rumors started to spread that the business or the bank might be in trouble. So with SVB unable to meet its withdrawals, the FDIC took over control of the bank from management over the weekend. They also immediately announced that all insured deposits would become available come Monday. And for the remaining 95% of uninsured deposits, the FDIC would need to begin selling some of SVB's assets. This process could of course take some time, but ideally over time, over the long run, most of, if not all of the deposits would be able to be recovered. But while it seems all well and good that customers will get most of, if not all of their money back, there were still a few key issues that threatened to spread losses throughout other financial institutions and other businesses. Bill Ackman was very active on Twitter over the weekend, participating in a few Twitter Spaces sessions to voice his concerns. He estimated that 98% of deposits would be recovered, but that there was still a huge issue of the timing of that recovery. Without access to their deposits immediately, Ackman was concerned that many tech companies may face cash flow problems that could spread very quickly. A prime example of this problem started to occur with one of SVB's customers, Rippling. Rippling is a tech startup that makes payroll payments for other small businesses, and they used SVB as the bank for which they paid employees of their business clients. Yesterday, Rippling was forced to notify customers that it couldn't provide payroll to their employees, which is an example of how not only are SVB's customers being affected, but the customers of their customers too. And that raises concerns about how this issue could spread quickly across the economy. But the even bigger threat was the potential for further bank runs come Monday morning. A third of US deposits are held in small banks, and 50% of deposits are not covered by FDIC insurance. So as the weekend progressed, the new concern came that on Monday morning, many businesses and individuals may move their funds, withdraw their funds from smaller banks into larger banks that are better equipped to handle a bank run, and that actual process of panic may cause a significant amount of bank runs at smaller institutions. This is where the real risk of contagion lies, because not only would large withdrawals cause banks to sell a lot of assets quickly at losses, it would also flood the bond market with a lot of sellers, pushing the bond market down even further. And of course, the lower that bond prices go, when banks need to sell those bonds to get liquidity, the more losses, or the heavier the losses will be for those banks. So that brings us to today. Quite literally, while I was researching and planning this video, the US government has decided to step in to protect SVB's depositors and prevent further contagion. An initial statement by US Treasury Secretary Janet Yellen indicated that no major government bailout was on the table. She stated, "Let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and the reforms that we've put in place means that we're not going to do that again." What she's talking about is the fact that in 2008, not only did the government step in to protect customer deposits, but they also bailed out investors, owners, and many creditors as well. So while this statement was initially taken as bad news for depositors, the government is going to be stepping in. Firstly, the FDIC is still insuring customers $250,000 per person, but now uninsured deposits will also be backed by the government come Monday morning. And as promised, this isn't a bailout of investors or creditors, and it isn't going to be taxpayer funded. The uninsured deposits will be backed by the Deposit Insurance Fund, which is owned by the FDIC, a fund that is funded by quarterly fees from financial institutions. So in essence, it's the banking sector with their fees for FDIC insurance that will be paying or covering and protecting depositors in this circumstance. The goal is to allow SVB's customers to access all of their deposits to essentially prevent any flow on or contagion into other banks and other sectors. Then over time, the FDIC can still sell SVB's assets and essentially recoup some of those funds. The bad news for investors in SVB is that they'll probably be wiped out entirely. So to ask the question from the introduction again, Is this going to devolve into a full-on financial crisis? While this is a rapidly evolving story, at least so far, there has been limited contagion, and a big part of that is due to the government stepping in to provide protection so quickly. And limited contagion is the correct word because there has been some. There was another bank failure yesterday, Signature Bank, which is a big lender in the cryptocurrency space. The bank had about $90 billion of deposits as of the latest filing, so it's about half the size of SVB. The good news is that Signature's deposits are now also protected by the FDIC in the same way that Silicon Valley Bank is. But what happens next is very much up in the air, and there's really little point speculating about what could happen. The facts as we know it so far is that the government is willing to protect customer deposits, which should reduce the risk of further bank runs where most of the deposits are uninsured. But the truth is, we really don't know how people will behave, and people still may panic and move money quickly out of smaller institutions into larger institutions that are less likely to face a bank run. But despite these issues, we're nowhere near financial crisis mode, so there's really no reason to panic. Unless you're Jason Calacanis, who's apparently pretty bad at hiding the fact that he lost money in SVB. But in all seriousness, you are probably going to see a lot of fear-mongering around this topic over the next few weeks, so it's important to stay grounded and just know what your long-term investment objectives are and stick to those rather than getting sucked into what's going on in the short term in finance or the economy. And if you want to stay up to date with all of the news around SVB and anything else going on in the economy, then I highly recommend you go check out Seeking Alpha, which is the sponsor of today's video. Seeking Alpha is a massive online community of stock pickers, and the premium plan has a ton of awesome features for investors. Expert analysis and news for thousands of different stocks to help you learn the ins and outs of what's going on with companies and the economy. You can import and track your own portfolio, including adding buy or sell price alerts. There are consensus buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. You can screen for stocks using a variety of fundamental and technical analysis metrics, access up to 10 years of financial data and company filings. There's also a ton of educational content to help improve your skills, including webinars, podcasts, and articles. And best of all, if you sign up at the moment, you can try an annual plan for as little as $8 per month. So go check it out. Head over to hamishhotter.com/seeking alpha or use the link down in the description below.